Hey everybody, in this video we're going to work on solving the problems from the chapter 1 to 4 study guide. Here are the work problems. And here I've got kind of a template. This is what you all can download yourselves to practice with too. And I'm going to paste in here. You can see a copy of the study guide. You can do the same thing if you want, but you can also just review that in paper or in form or whatever in your packet, so on and so forth. So, but anyway, here for the first problem in our practice, we're going to be needing to prepare a multi-step income statement, statement of retained earnings, and classified balance sheet as of the end of this year for your corporation. And so we've got all these different accounts essentially, and we've got balances, etc. And we've got I've got them kind of, designed here as the financial statements top to bottom. And we've got the income statement, statement of retained earnings, and then the balance sheet. So the first thing that we want to do is go through and prepare our income statement. That's why it's at the top. And when we're looking at the multi-step income statement, the main thing is that we have a breakdown of some of these specific categories like operating expenses. This one is a merchandiser example, so it has a place for us to calculate net sales and gross profit. And then it has this other revenues, gains, losses, and expenses section, a section for us to put our tax expense in, etc. This problem doesn't have any tax expense noted, but in the multi-step income statement, and typically for most businesses, that is an expense. And then we've got our retained earnings statement, etc. So let's start here at the top. So when we're calculating net sales, remember that is going to be sales, and I think I'm gonna do something here. Insert a shape. I'm just gonna have this so we can sort of check things off as we go. So I'm gonna put sales, and let's see if we have enough spaces here. Yeah. And then we're gonna put that. So that's our revenue essentially. And then we're gonna have a couple other lines to get us to net sales. Those being sales returns and allowances. And then also sales discounts. So I'm just copying and pasting these little lines that I created just so we can kind of check, helps you check those off as we go. You could do this on paper, just put a check mark next to them or something. But okay, and remember that our sales discounts and our sales returns and allowances accounts are contra revenue accounts. So remember, sales is a revenue account, sales revenue. But then these two accounts are contra revenue, which means that they will subtract from total sales. So that's what we're seeing here. And hopefully that makes sense, right? Discounts and returns are things that reduce our original sales, revenue that we would bring in if we didn't if we didn't have any returns or if we didn't provide any discounts. Okay, and then to get to gross profit, there's one thing we're going to take out, and that is our cost of goods sold. So we're going to put that in, and that's going to be a $500 reduction. And so again, that's kind of saying we're a merchandiser, reseller of items. And so to sell those items, we had to buy them in the first place. And this cost of goods sold is the cost of what it took for us to, have those items in our inventory to be able to sell them in the first place. Okay, so that's good. That's down to gross profit. And then we're going to calculate out our, we're going to put all our operating expenses in here. So let's just go down the list. We've got utilities expense. Spelled that wrong. Let me spell check real quick. Okay, we got utilities expense. We've got supplies expense. What's next? We got salary expense. And remember, these are all things that are expenses that are incurred in the normal operations of the business. And you compare that to things like interest, revenue, and expense. We're going to put those into the other section, so know that. Let's see what else. Insurance expense, though, is an operating expense. We're incurring these expenses in the primary function of the business. And gains is another thing. Gains and losses. It says gains and losses here, too, so maybe that helps you kind of understand that. But those also will go in that separate section. But depreciation expense is a normal operating expense. And what else? Advertising expense. Okay. So let's go back and just put all these in here. We've got 15, 15, 500, 15, 15, and a lot of 15. Is that right? Oh, weird. Yeah. Okay. I didn't design this problem, but they're all 15 except for the salaries expense. So go figure. Okay, so then to calculate operating income, that's just us taking gross profit minus our operating expenses. And then we're going to go through and put the amounts in for the other stuff that we were talking about, other revenues, gains, losses, and expenses. So this is where we're going to look at interest, revenue, and expense. And then so that's those two, interest expense, interest revenue, and then, like I said, gains and losses. So gain on sale of equipment, and we got loss on the sale of land. Gain on the sale of equipment and loss on sale of land. Okay, and let's put these in. And be careful with these ones. You want to have the pluses and minuses right here because the revenues are positive, the expenses are going to be negative, and gains and losses similarly there. Losses negative, gains positive. So overall, we get a total other revenues, gains, losses, and expenses. Total other of $5, I guess, for whatever it is. In this instance, just using small numbers, basically. A lot of times you'll see in financial statements, they will have smaller numbers noted, and then those would be dollars in, maybe millions or thousands or something. So it could be relatively large figures, but it just looks like lower numbers, just FYI. But okay, and then the only other thing we would have here to come to our net income then. Here, let's do this real quick. So operating income plus we have a positive total, it's plus the $5 gets us to $420 on pre-tax net income. And then we've got $0 for tax expense. It just doesn't tell us anything about tax expense in the problem. And so the net income is the same as the pre-tax net income, just because we're not taking anything out, essentially. So, and then that gets us there. So, and then remember this. So the net sales is the sales minus the returns and discounts. Gross profit is this net sales minus the cost of goods sold. Then the operating income is the gross profit minus the operating expenses. And then pre-tax net income just adds in the other revenues, gains, and losses and expenses. And then if you have taxes, that comes out to arrive at a net income figure, essentially. Okay, so let's kind of, this might be a little difficult. Geez, now I've got to select all these. All right, maybe that wasn't the best idea, but it's okay. I'm going to move this thing down, and if I don't select everything, it'll move weird. Okay. So I'll move down a little further to the balance sheet. Okay, so as far as retained earnings statement goes, we're looking for beginning retained earnings. So this thing tells us, we're at the end of the year, 12/31, but you can see here we have retained earnings at the beginning of the year. So that'll be 105. And then we're going to add in our net income. Remember, that's an important part of doing the income statement first. So we'll just bring that down. And then we'll take out dividends. And we've got dividends listed as 20. So then our ending retained earnings becomes 505, and that was just us adding all those together. So beginning plus net income minus the dividends. And remember, another way to think of this too, it's helpful to remember, or it's a good thing to remember, that equity or retained earnings includes, it's added, it increases with revenues, decreases with expenses, and so net income is the combination of revenues and expenses, and then minus the dividends. Excuse me. Okay, so that's good, and then we can bring down right away if we want to that ending retained earnings number just off the statement. So that's why we need to do the second statement as the retained earnings before balance sheet, because we take the ending retained earnings to the balance sheet. Okay, and then we're going to go through our current assets, and in current assets we have always the number one thing to put in is cash. It's the most liquid asset. And then accounts receivable usually is the second. So always have cash and AR first, and then it kind of just sort of depends. The things like supplies, prepaid insurance, prepaid expenses. This one we have a short-term note payable. It specifically brings that up, or sorry, short-term investment. So we're going to include that in a current asset. What else? So, do we have supplies? Oh, excuse me. Maybe that's everything. Let's see. It's kind of why I like to mark these off, just so we had cash, AR, supplies, short-term investments. Again, anything shorter than a year, or if it denotes it as short-term, we'd include it as a current asset. Prepaid insurance, both this note receivable is out into 6 years later, 5 years later, so that's not current. And I think that's everything. Oh no, inventory. There we go. Inventory will always be a short-term asset as well, generally, unless it's denoted otherwise. Okay, so let's put our numbers in here. We got cash, AR, both 30, supplies of 5, prepaid insurance of 50. What's our short-term investment is 10, and our inventory is 20. So that means our total current assets are 145. Okay, now let's go into our plant assets, also known as plant, property, and equipment, PP&E, or can be called fixed assets too, or capital assets sometimes. Different terms for the same thing, but basically it's all the stuff that depreciates or is land. So we're gonna have a machine, and then we're gonna have an accumulated. I'm gonna denote it just like they do here. The accumulated depreciation accounts are going to go in this section. Remember, those are contra assets. And then we're going to have a building and accumulated depreciation building. Building. And then finally we have land. And note that there's two different kind of land items here. So we have land used for operating the business, and then we have land as an investment held for speculation. So the investment land is going to go down here in the long-term investments, but the land that we actually are using in the operations is going to go here with the plant assets. Okay, so our totals then for our plant assets are the building, let's see, our machine is how much? 100. We've got accumulated depreciation of 10, building of 500, accumulated depreciation of 25, and then the land is 20. And then we just add those together. And again, remember the contra revenue is what reduced revenue, and then the contra asset goes with the assets, but it reduces the asset values. And one thing to note here, do I have a spot? I don't have an extra column, but a lot of times, probably the real proper way to do this, I don't care if you do it like this on the exam, but the proper way to kind of show these totals would be more so to, let me do this real quick. So it would be to show the net book value of the assets, which is to say, take the historical cost and then minus the accumulated depreciation, and this gives you the book value, the current net book value. So really, it's, this is the historical cost, but this is the depreciation. So the combination of the two gives you these values, and that's more so kind of what you'd see in an actual financial statement, etc. But like if you want to put it this way and just have it all in one row, that's totally fine for the exam. Okay, long-term investments. Like I said, we've got land held for speculation. What's that? 15. And then what's another one we have? Oh, our note receivable. So you can see this is a long-term. Usually we see notes payable. That's where we have long-term debt that we borrowed some money from someone. But in this instance, we have a long-term note receivable, which means that we've lent money out and we're earning interest. And that kind of makes sense because we saw interest revenue noted above, right? So kind of you might understand where that's coming from now that you see we have this outstanding amount of lending that we've done. Okay, in terms of intangible assets, those are things that are not, tangible, which means they're not physical. And so in that regard, we have trademark, 50, and we have a patent. So that's 25. Okay, that gives us 75 total. So I think now we've got all of our components together. We've got current assets, plant assets, long-term investment assets, and intangible assets. So we just add those together to get our total assets. 850, cool. And we're almost done here. Let's go down to liabilities. And in our liabilities section, we've got AP is always basically the first one you want to put in there. Accounts payable. Okay, and we've got interest payable. What else do we have? Unearned revenue. And throw that in. Salary payable. Probably salary payable should be the second one down. It's probably the most current to be paid behind accounts payable, but that's okay. We'll just put it here. What are we missing? Okay, bond payable. So we have this amount. A bond is a kind of a borrowing as well, kind of like a note payable. But that is due, and this one's a short term. This portion is due. You can see it's 12/31 is the end of the year that we're putting the numbers in for, and this is due in like 4 months, 4/1 of the next year. So it will go with the current liabilities. Okay, so 20, the bond payable, or what do we got next? We got interest payable, 20 as well. Unearned revenue of 60, salary payable of 25, and then bond payable of 90. So add those all together. 215. Okay, and then we're getting pretty close to marking off every account. So note payable, and then we have a long-term note payable. Not due for another 7 years, it shows. And that's 50. And I think that's everything other than common stock. So there's only just that one. Let's put the common stock 80. And I think we've checked off every single one. So let's add our long-term liabilities plus the current, gets us 265. We can sum up our equity. And then remember, our accounting equation is saying our assets equal our liabilities plus equity. So liabilities plus equity is 850, and you can see assets equals 850, and so we balance, and we are good. So really, it just comes down to knowing how to allocate all the assets that are in here, and knowing what statement comes first and all that kind of stuff. So, okay, I'm going to delete this out, and then, geez, now that I've got all these marks, it's a slight hassle. Bear with me 1 second. start looking at the rest of the problems here. There is probably an easier, quicker way to do this. Oh, interest payable. I did have that in there though. I think in Excel there's a way to select every kind of, line or thing that you created, delete them all at once, but that's fine. That wasn't too bad. Okay. Perfect. All right, well, let's move on to the second. Okay, so we're going to work on the second section of our practice problems here. So I copied and pasted it from the Word here so we can see that. I'm going to hide this right now just so it's a little more easy to see. This one, and actually, you know what I'm going to do too? I'm going to add a border. All right, did that do it? Yeah, just for the sake of it being a little clearer, easier to see. Okay, so let's go and do, and this is just some journal entries we need to know how to do related to being, a merchandiser, and then some standard journal entries. This company we're going to be doing journal entries for is both a merchandiser reselling things, and then it's also a service provider, so kind of a hybrid of the two types of those types of businesses. And let's take a look. Okay, so on 11.1, it shows that we stockholders invested $35,000, a $35,000 automobile, and $15,000 cash in exchange for the stock. So again, a lot of times we just see cash as kind of the initial journal entry. But in this instance, we have an automobile, which is just, another asset being put into the business. And then the total value of the things that were contributed to the business becomes the value of the common stock that the shareholders then have. And we'll just say, I'm not going to go into too much. Spell this right, initial investment. Okay, and again, remember, automobiles and cash are assets, so be sure you know your debits and credits. Assets are increased on the debit side. Common stock is increased on the credit side, so those are both increases to both those. Okay, on the second, we've got, we purchased 500 widgets for $3 each from Supplier Co. So now we've got some merchandise inventory. And we've got accounts payable as our credit. We're going to pay this later. So that is 500 times 3. So the value of that's $1,500. And we'll just say Supplier Co. And we'll say 210 net 30. Okay, on the third, we returned 80 widgets and received a credit memo. So when we make a return like this, we're just reversing our journal entry above, essentially. So we're going to debit our accounts payable to reduce it, and then we're crediting our inventory to reduce it. So this is an asset and a liability. So those are both increases to those types of accounts, and now these are both decreases. And we've got 80 widgets, 240 after you multiply it by what we paid for it. And we'll say Supplier Co. credit memo number 125. Okay, on the sixth, we sold 200 of these things to Customer Co. for $5 each with certain terms. And we're saying the cost was $3. Okay, so then remember our sales entries, then we get accounts receivable, sales revenue. Now, and that's the portion that we're actually charging the client. So we sold them for $5 each. So we're making $1,000 on the sale. And then we have to account for the cost of, what it costs for us. So we're taking it out of inventory. So cost of goods sold is our expense to indicate that we've, used up this merchandise, if you want to think of it that way. And then I'm just going to link above here to save some time. We have the merchandise inventory asset going down to show that it's gone. It's with the customer now, basically, right? So 200 times $3 a piece, so $600. So we made a net profit on the sale of $400, right? The sales revenue minus cost of goods sold. And yeah, 200 times 3, and then 200 times 5 for the sales revenue. Oh, computer glitching a little bit. Okay, so then Customer Co. returned 10 of the widgets, and we issued a credit memo. So now they're coming back to us. So let's say Customer Co. and we'll put the terms in here, 215 net 60. Okay, now they return some of it back to us, and so when they return it back to us, we essentially reverse this entire journal entry with the exception of the fact that we don't use sales revenue, but instead we use sales returns and allowances. Remember that contra account. So just for the heck of it, I'm going to link over here because I already have that account noted. So that's going to be our debit to instead of debiting sales revenue. But then in all other aspects, we're just going to reverse. We're going to get the inventory back in. We're going to reduce our cost of goods sold. And how much did they return? They returned 10 of these things. And so the amount of the sale that's going down is 10 times 5. And the amount of the cost coming back into our inventory was 3 times 5. So remember, oh, that didn't work. So this was, that it's just the 10 of them. 10 items being returned, not, we sold them 200. So that's kind of just the reversal there. And then we're going to say customer co. Credit memo number 23. Okay, on the 9th, we paid supplier co by issuing check number 100. So supplier co is the one up here that we made these two purchases from. So the first thing I like to do on these is to get rid of our accounts payable in total. So, and then we'll figure out the discount after. So the amount of accounts payable, it was $1,500 to start, but then we returned some of the merchandise, so $240 worth. So we have a $1,260 payable. And then we're going to credit our cash because we're paying with cash, so cash is going to go down. And if we didn't take the discount, it would be the full amount of the payable that we owe, but we are paying within the discount period. So instead of that 100% of that $1,260, it's going to be 98% because we're getting a 2% discount. Okay, and then again, another contra revenue account here, sales discounts will be the balance. So we can just plug the difference between those. And if we wanted to figure out sales discount first, we could have taken the total accounts payable times 2%. But we just did 98, and then you could do this one by 98%, etc. So, or you can just take 2% and then take 2%, minus that to get 1235. However you want to do it, but yeah. So supplier co payment. Okay. Then on the 15th, we received payment from customer co. So now again, we're gonna reduce accounts receivable. And always the accounts receivable and payables go to 0 on these transactions. So I like to start there. So it would have been $1,000 they're paying to us, but they returned some of the goods to us, so $50 worth. So it was $950 was the outstanding receivable from this customer once we accounted for their return. And then we're going to get a portion of cash. It would have been $950, right? Again, just like we would have paid $950, we didn't have a discount, but we're offering a discount now that they are within the time period of, and I believe it was 2% as well. So we can just take that 950 times 98%, and then the difference is, oh, you know what? Let me make sure I didn't lead you guys astray on something. Sorry, I messed this one up. That's not sales discounts. That will be merchandise inventory. Watch me. Yeah, you got to watch me on that one. I always mess that one up. So this is saying, because remember the sales discounts and returns, sales discounts is just for sales that we make. But when we get a discount on a purchase, we're just going to reduce the merchandise inventory for that. So I always make that mistake. Sorry. So don't make my mistake there. And then, but yeah, it should be reducing merchandise inventory for the difference between the amount actually paid. So when we're receiving cash and giving a discount, that's where we got sales discounts to note. And again, you can just take, I'm just doing 98% of the total outstanding, and then the difference is the discount there. And then you can see where that goes on a financial statement, kind of like looking over on this part. Okay, so we're getting pretty close. The rest of the entries are pretty easy. So we purchased a table. So I'm going to just call this, put it to the furniture account. And that was on account. So accounts payable, 3,000. Office Depot invoice number 2542. Then we paid $2,000 for November insurance. So this is insurance expense. And this one is, I would be careful not to make my mistake. When I first was looking at this, I thought, oh, prepaid insurance when I read that. And then I was like, oh, wait, let me read that real quick. Okay, November. We are in the month of November. So remember, if it's not prepaid for a future month, then it's just an expense in that period. 11/19, we performed services and received cash. So now we got cash coming in, and this is service revenue. So we're not sales revenue, but service revenue. Sales revenue would be us, selling the merchandise like we did above. And that was 5,000. What is this? Client co. Okay, and we'll just say, oh no, sorry, that was, no, that's right, client co. Invoice number 10. Okay, on the 20th, we paid $3,000 to landlord co. Now this one is prepaid because we're paying for December and January. It's prepaid rent. And how much was it? Oh, 3,000. Okay. And we'll say December and January rent. And we could even say, it shows it above, but we'll say prepayment. Obviously, prepayment by the accounts we used. Okay, and then on the 25th, we paid the amount owed to Office Depot. So that's basically us, debiting our accounts payable to reduce it to 0, and then crediting cash to show our asset of cash going down. And we'll just say Office Depot payment. And finally, on the 27th, we received a $5,000 advance payment for services to be performed next month. So remember, we got the cash goes up. And then unearned revenue is our credit. And we'll say pre-payment from customer local co. We'll just leave it at that. Cool. So the fact that we haven't earned it yet, that cash is in our hands, so it went up, right? That's why we debit, but we have not earned this cash yet until we perform the services next month. So it's a liability at this point. You saw that in our balance sheet with unearned revenue down here in liabilities. Cool. All right, that is that portion. And then let's take a quick look here. Let me unhide. So I was just hiding those columns, but let me snip a screenshot of our final little portion. Okay, so we got 4 entries here. I'll pull it down as we go just to, or you know what I'm going to do? I'll scroll over. Okay, so the first adjusting entry tells us that our trial balance shows $1,000, but there's only $800 left. What adjusting entry is required? So we need to adjust down from $1,000 to $800, and so we're going to do just the difference between them, $200, and let's just say supplies expense, and then supplies the asset being reduced. And this will be to adjust supplies balance. I'll say to actual. So that kind of indicates like the actual balance is 800, but so it's not the 1,000 it currently shows. We need to reduce supplies by 200, and that's what we're doing with that credit. Okay, the second one, it says we received a $12,000 advance on July 1st, and it's for 12-month services. Starting July 1st, we had no previous adjusting entries. So what entry do we need to make? We're going to want to reduce our unearned revenue and record revenue basically for the time period. So to reduce our liability of unearned revenue, we're going to debit it. We're going to record revenue. And it doesn't really say what, service revenue, I guess we say that. And it's going to be $12,000, so $1,000 a month. The time, there's 6 months starting 7/1 is what it tells us. So 6 months. So we basically earned half of the amount that was prepaid. And we'll just say service revenue. What do we want to say? I'll just say this 7/1 to 12 12/31 revenue earned. Okay, the next one says our company paid $24,000 of rent in advance on 9/1, and the advance was for 6 months rent. So if we divide 24,000 by 6, we get $4,000 of rent per month. And assuming no previous adjustments, what entry is required? So when we had originally booked our first entry, right, we do debit, prepaid rent, credit cash for 24,000, and now we need to reduce it for every month that's gone by. And we're at 12/31. And it started on 9/1, so we had the month of 9, 10, 11, 12, so 4 months has passed. So we're going to record 4 months of rent expense, and we're going to reduce our prepaid rent asset by that same amount, basically. So 4 months was $4,000 a month. So prepaid rent will go down by 16,000, and we'll have 2 months left, which would leave 8,000 in the prepaid rent account, essentially. And I guess we're just going to do the same thing again. 9/1 to 12/31 rent expense. All right, and the last problem here is it tells us your company purchased a machine for $24,000 on 10/1. This salvage value and useful life, and so we need to book a depreciation expense entry. So we know that we're going to debit depreciation expense, and we're going to credit accumulated depreciation. In this instance, machine. If you were on an exam and just put accumulated depreciation, I wouldn't mark you off for that, but it is good to specify the specifics. So to calculate monthly depreciation, because first let's get a monthly amount, and then we're going to need to do 3 months, so October, November, December, because we bought it on 10/1 and we haven't recorded any depreciation yet, so we need 3 months worth. But let's start by just calculating 1 month's worth. So we have 24,000 cost minus $3,000 salvage value, divided by the life of 10 years, or we want months, so 120 months. So it's going to be $175 per month. And then we just need 3 of those because we've got 3 months that have passed by since we first bought the machine. So 525 will bring the accumulated depreciation up to where it should be after 3 months, basically. So let's see, so 10, we'll just put continuing with our explanation thread here, depreciation expense. So again, that's cost minus salvage. So this is every time you do depreciation, it's the same formula. It's called straight line depreciation. It's just the cost minus the salvage value divided by the life. And again, that's monthly because it's the number of months in total. And then we're just going to take how many months we need to record, and it's 3 in this instance. So typically you do them every month. So these problems are a little bit, funny in that regard. Like generally you'd probably want to be recording depreciation expense every month, rent expense every month, so on and so forth. But these problems are just designed in that way to make you kind of like have to do some deeper analysis and understand how, if we needed to clean up the records or record multiple months at once, then we could. So, all right. Well, thanks everybody. Hopefully this video is helpful. Good luck on the exam, and I will see you in class. All right.